Hey, this is Chris, and in this video I'm going to be talking about small cap shares versus large cap shares. It's a question I get quite often in the Ask Chris section of our newsletter for subscribers and clients, which is, should I be buying small cap shares instead of large cap shares? Now actually, if you have a look back in history, there's actually been quite a few studies that have been done into exactly this. Do small caps perform better than large caps? The most famous study was done in 1992 by Fama and French. And what they found was that small caps, at least in the US, indeed do better than large caps. Although I should point out that a small cap in the US in their study was considered a company of 2 to 10 billion in size and a large cap over 10 billion. In Australia, small caps are a lot smaller than that. So the reason you may consider owning small caps in your portfolio would be based on the research that they did, which is that they do tend to perform better, at least up until that study date in 1992. Although the research has been explained by others as due to a couple of reasons. One of them is the lower liquidity in small caps, so they're harder to get in and out of. And also small cap companies tend to be more susceptible to the business cycle. So they tend to be more volatile and do well in periods of market booms, and tend to do very poorly when markets fall. And the theory goes that you actually get rewarded with a higher return for small caps because you're basically taking much higher risk. So that would be the kind of negative around owning small cap shares. Now recently, if you actually have a look over the last 20 or 30 years, small caps in Australia and in the US haven't actually performed better than large caps. Interestingly, large caps have performed as well, if not better. A lot of small caps actually that have been successful have become large caps, and it's actually been the large cap companies that have been the bigger drivers of market returns. Companies like Amazon and Microsoft and Apple in the US, and businesses like CSL and BHP in Australia. So the experience that led up to that 1992 study hasn't actually been repeated after that, and actually despite small caps performing better before that, they've performed equal since and actually taken higher risk. So over the last 20 or 30 years, you actually would have been better investing in large cap shares. That said, if you do want to invest in small cap shares, ETFs are a great way to do it. So in the past, you would have had to buy a small handful of them, and because only a few of them are likely to succeed, you'd be quite exposed to missing out on those good performers. So the benefit of ETFs these days is that if you do want to own small caps, you can own a very broad portfolio of them, either through a specific small cap ETF. We actually offer one as one of the StockSpot themes, or as a equal weight ETF. So an equal weight ETF, rather than putting more of the money in the large cap companies, spreads your money equally across all of the companies, and therefore tends to put more weight in small caps, and so you do better when small caps do well. Now, over the long term, as a long-term investor, my advice would be that you don't specifically need a small cap ETF or small caps in your portfolio. In fact, the broad ASX 300 ETF is perfectly sufficient, and it will give you good exposure to the large cap companies and most of your portfolio in those, and then a smaller amount of your portfolio in small caps as well. And to be honest, over the long run, that's going to be perfectly fine for your portfolio. Now, if you like content like this or want to see more videos around the types of ETFs you should be considering, you can subscribe below.